Okay, let's think about this. Imagine a massive cyber attack hits hundreds of your clients all at once.
Right. Your claims teams are just swamped
Yeah,
instantly.
exactly. Or, some sudden climate event devastates a whole region.
Mm-hmm. And businesses, communities that are left waiting, sometimes for months, right, for critical assessments.
Yeah. Traditional insurance, I mean, it's been our bedrock, it's reliable, but it can sometimes struggle with these modern, rapid, widespread kinds of risks.
It can.
But what if there was maybe a smarter way, a faster way to deliver that relief? A shortcut that could cut costs, maybe even open up completely new markets.
Well, that's where index insurance comes in.
Today, we're diving deep into index insurance. Now, it's a concept that's it's been around a while.
It has, yeah.
But it's really gaining some serious new traction now, especially for these complex, evolving risks like, cyber attacks or climate events, precisely because it tackles those challenges we just mentioned.
And what's truly fascinating here, I think, is how index insurance really tries to bridge those significant protection gaps. The areas where conventional models sometimes struggle to cover things effectively.
Okay.
Our source material for this deep dive is this really cutting-edge paper. It thoroughly explores its viability and, crucially for you, listening as a risk manager, how it can compete or even, combine with the traditional approaches.
So it's about using data differently.
Fundamentally, yes.
Yeah.
Leveraging data to simplify things, speed things up.
Right. So that's our mission today, to pull out the most important nuggets of knowledge from this research. We're focusing on what this means for you, the risk manager, thinking about product design, understanding demand from policyholders, and of course, the big one, ensuring solvency.
Mm-hmm.
Get ready for maybe some insights that could genuinely reshape how you think about modern risk transfer.
Let's get into it.
So, okay, let's start with the basics. What exactly is index insurance? How's it different?
Well, unlike traditional insurance, where your compensation is based on an actual loss assessment.
Which can take ages.
Exactly, often lengthy. Index insurance bases its payouts on something else, entirely a measurable index, or a specific parameter that's been agreed upon beforehand.
Okay, like what? Give us an example.
Think about agriculture. Instead of sending adjusters out to measure crop damage on every single farm after a drought,
Right.
you might pay out based on, say, a predefined rainfall deficit level for that whole region hitting a certain trigger point.
Got it. And the source we're looking at uses a cyber example.
Yes, specifically for cyber insurance. It illustrates this using the duration of business interruption as its core index.
Interesting.
The idea is pretty straightforward. If that index, the duration of interruption, hits a certain threshold.
A payout happens automatically.
Precisely. No need for that specific individual loss assessment.
So the benefits seem pretty clear from the insurer's side then.
Well, absolutely. From an insurer's perspective, this brings, a whole host of compelling benefits. First, you get significantly faster payouts.
Which policyholders must love.
Huge benefit for them, getting liquidity right when they need it in a crisis. Second, it dramatically lowers your claim management costs.
Makes sense. Less investigation needed.
And naturally reduces legal disputes too, because the payout conditions are, clear and predefined.
Black and white almost.
Pretty much. For the insurer, it also means better risk control. You're relying on more reliable data, robust statistical estimates when you design the index. It's just a cleaner, more streamlined process overall.
Okay. But you mentioned it's different from things like cat bonds.
Ah, yes. That's a critical distinction. Index insurance relies entirely on the possibility of mutualization. Meaning pooling a sufficiently high number of policyholders together.
Yeah.
That collective risk sharing, that's its fundamental pillar. Cat bonds and other index-based financial instruments don't necessarily work that way.
Okay, that pooling, that mutualization makes sense. But here's where it gets, maybe a bit tricky for me. The paper really highlights something called basis risk.
The central challenge.
Yeah, this is the inherent problem with index insurance, isn't it? It's this risk that the compensation paid out.
Well, it doesn't perfectly match the policyholder's actual loss.
That's exactly it. It's an approximation.
And the research suggests this can be a pretty significant barrier.
Yeah.
Hindering its development, its adoption. If you don't manage it really carefully, how does that ripple through everything else?
Oh, it absolutely impacts everything. Because basis risk ties directly into the demand equation. You see, for any index insurance product to be viable, sustainable,
You need customers, a lot of them.
you need a sufficiently large number of policyholders, Without that really robust base, the pooling mechanism we just talked about, its backbone,
It can't hold up.
it just can't withstand adverse outcomes. It jeopardizes the product's economic viability. It can even make the cost of designing the index itself too high to be worthwhile.
Wow. Okay. So the demand side isn't just about, selling policies. It's fundamental to how index insurance even functions.
That's a really powerful distinction. So, okay, for you, the risk manager listening, what are the practical levers? What can you actually pull to make index insurance attractive, to overcome that skepticism about basis risk?
Well, our source highlights several key factors.
Let's break them down. First up, compensation delays in traditional insurance.
Right. Traditional indemnity-based compensation, it often comes with significantly longer delays, doesn't it?
Absolutely. Which can be incredibly problematic for policyholders who need cash, like yesterday after something happens.
Our research shows that if your competing indemnity product has significantly longer delays,
So speed matters a lot.
it really does. Even very risk-averse individuals might actually choose the index insurance option because of that speed. This speed advantage is a major lever you can pull.
So you're selling immediacy, quick relief.
As much as you're selling coverage, yes, speed is a huge differentiator.
Okay, what else influences demand?
Then there's policyholder risk aversion. How comfortable are people with risk?
Right. And generally, more risk aversion works against index insurance, I'd guess, because of that basis risk.
That's the general rule, yes. More risk-averse people might prefer the perceived certainty of a full indemnity payout, even if it takes longer.
But
But the research reveals something interesting. Moderately risk-averse individuals, they might actually be swayed by the potentially lower price of index insurance.
the cost factor.
Exactly. They might look at the trade-off, slightly less certainty versus a lower premium, and decide it's worth it. It's a specific segment of your market where price sensitivity can actually override some of those basis risk concerns.
Okay, which leads us nicely to the price itself, or the loading factor.
Precisely. The loading factor, that's the additional charge on top of the pure premium.
And index insurance can usually have a lower one, right? Because admin costs are lower.
Typically, yes. Reduced management costs mean you can offer a lower loading factor. But here's a slightly counterintuitive aha moment from the paper. While just cranking up the loading factor seems like easy profit.
It reduces demand. Too expensive.
Right. But the research shows that finding the solvency-driven minimum loading factor, the lowest you can go, while still being safe.
Okay.
That isn't just about break-even. It's actually your key to unlocking competitive pricing. Pricing that can dramatically accelerate market adoption.
So figuring out that minimum isn't just a constraint, it's a market advantage.
Exactly. It turns a financial necessity into a powerful tool. And finally, there's the power of prediction models. This is critical.
How good is the index, basically?
Essentially, yes. The paper demonstrates quite clearly that the accuracy of your index design directly impacts demand.
How so?
Well, they used advanced machine learning models, specifically naming things like random forest or XGBoost.
Okay, sophisticated stuff.
Yeah, and these models, because they have superior predictive performance, they actually reduce basis risk.
Making the approximation better.
Correct. Which in turn makes the product inherently more attractive, drawing in more policyholders. It really highlights the positive impact that, cutting-edge AI can have on actually commercializing these products and making them viable.
Fascinating. Better models mean less basis risk, means more demand?
That's the chain. And this leads us straight into the insurer's other major concern, solvency.
Right, keeping the lights on.
Always critical. And it raises that important question. How large does your portfolio of policyholders need to be to ensure you remain solvent with a very high probability?
And regulators have specific rules here, don't they?
They do, especially in Europe. Regulators typically require insurers to hold enough capital for usually a 99.5% probability staying solvent over a one-year period.
So your probability of ruin has to be incredibly low, like 0.5%.
Exactly. It's a very tight margin to operate within. Demands very careful calculation.
And just to make things more interesting, there's this challenge the paper calls accumulation phenomena.
Yes. Yeah. That adds another layer.
What does that mean exactly? It's not just about lots of individual claims, is it?
No, it's about when a significant number of your policyholders all experience claims in a very short period. Think about it.
Like a regional cyber attack hitting dozens of businesses using the same vulnerable software.
Perfect example. Or a widespread hailstorm blanketing an entire agricultural district where you have many farming clients.
So a concentrated hit.
Exactly. The research models this as an additional, often heavy-tailed loss potential. And logically, dealing with this means you need one of two things.
Either even more policyholders to spread that concentrated risk wider.
Right, enhancing the mutualization
Yeah,
effect.
or you need a higher loading factor to build up more reserves to absorb those potentially huge correlated losses.
Correct. It adds an extra layer of complexity to figuring out your capital requirements.
Okay, so how do loading factors and solvency interact?
Well, the research shows this really fascinating inverse relationship. As you increase the index insurance loading factor.
You earn more per policy.
Right. So the minimum number of policyholders you need to achieve that solvency target actually decreases.
Ah, okay. That makes sense.
And this allows an insurer to figure out a minimum viable loading factor, the lowest point at which the product can be sold competitively while still meeting solvency rules.
And the cyber example had numbers for this.
It did. For their cyber example, the paper found this minimal loading factor was around 0.18.
Which is pretty low compared to traditional indemnity.
Notably lower. They compared it to about 0.40, often seen for traditional indemnity. That difference, that potential for a lower minimum loading factor, can be a real game changer for actually entering the market.
Okay, so let's try and pull this together for you, the risk manager. If demand is proving tricky, it may be because policyholders are very risk averse, or your necessary loading factor seems too high. You have options.
Strategic levers to pull.
Right. You could invest in optimizing claims management, maybe using AI to really speed things up.
Tackling that delay issue head on.
Exactly, which boosts demand. Or you could focus on education, really explaining the unique benefits of index insurance to the market.
Trying to shift that perception, maybe mitigate how much risk aversion influences their decision.
Yeah, framing the risk versus reward differently.
And this brings us to perhaps the paper's most innovative proposal, something they call the hybrid product.
Hybrid, okay, mixing things up.
Exactly. This strategy is about combining traditional indemnity-based insurance with index insurance, but using each where it's actually most suitable for the policyholder.
So, not an either.
Not necessarily. The core idea is to apply the index compensation only in those cases where it's expected to be most reliable.
Meaning where that basis risk is naturally lower.
Precisely. It's about the smart application of each mechanism to get the best overall efficiency.
Okay, let's walk through their cyber insurance illustration again. How did they make this hybrid idea work there?
So the challenge with cyber losses, as we said, they're often complex. Business interruption is usually the big one, not just, say, a ransom payment.
Right. Harder to quantify sometimes.
It can be.
Yeah.
So the index they chose for their model was the duration of business interruption.
Why that way?
Because it's highly correlated with the actual financial loss, generally speaking, and it can be measured pretty much immediately after an incident.
Yeah,
That makes it a powerful proxy.
makes sense. Quick and relevant.
Then they use those machine learning models, we mentioned regression trees, XGBoost, to really predict the relationship between the actual loss amount and this duration index.
And XGBoost came out better?
In their analysis, yes, it showed superior predictive performance, which helps further reduce that tricky basis risk.
Okay, and there was this parameter.
Yes, the E parameter.
Yeah.
Think of E as like a dial on your dashboard as a risk manager.
A control knob.
Exactly. It lets you fine-tune precisely when the index-based compensation kicks in versus when you stick with traditional indemnity assessment.
So a higher E means you use the index part more often.
Correct. You lean more heavily on index insurance for a wider range of scenarios. But there's a trade-off.
What?
You'll likely need to adjust the pricing, probably requiring a lower maximum loading factor for that index component to keep it attractive and viable given the basis risk profile.
So it gives you, the risk manager, this really powerful strategic control. You can balance how widely you apply the index part against the profitability you need from it.
That's the idea, balancing scope and profitability.
And what were the results from the cyber example? Did it work?
The results were actually fascinating. For their specific data set, this hybrid approach, using those ML models, it identified that index insurance is most suitable for claims involving short business interruptions and relatively small losses.
Which is good news, right?
It's a highly favorable outcome. Because basis risk generally gets worse, it increases with the size of the loss.
So the method naturally points towards using index insurance where it's already likely to perform best.
Exactly. The methodology itself recommends applying index insurance in the context where it inherently has lower basis risk.
Clever. Did they give any specific figures?
They did. For instance, using the regression tree model, The maximum allowable loading factor for the index part of the hybrid product was 0.32, but only when the policyholders' backup plans were successful in limiting the interruption.
Compared to 0.40 for traditional.
Right. And in those cases, with successful backups, index compensation was found to be the preferable approach in nearly 84% of instances.
Wow, 83.79%. That's a huge chunk of claims.
It's a significant proportion where index insurance could be deployed really efficiently, cutting down friction, cutting down costs.
That really does feel like a potential game changer. And this hybrid idea, it's not just for creating brand new index products from scratch, is it?
No, not at all. That's another key implication. It could also revolutionize how you manage claims within your existing traditional indemnity contracts.
How so?
Well, imagine being able to automatically identify certain types of claims, maybe smaller, simpler ones, based on certain criteria where you could bypass some of the expensive expert assessment.
Streamlining the process for routine claims.
Exactly. Yeah. Or applying different claims management policies based on predicted loss severity or specific characteristics identified by the model. It's about achieving more efficient, data-driven claims handling right across your entire portfolio.
Freeing up your expert resources for the really complex large loss cases where they add the most value.
That's the potential. More efficiency everywhere.
Okay. So wrapping up. We've seen today how index insurance really offers a potent solution for some of these protection gaps, especially with new and emerging risks. Its viability really hinges on understanding policyholder demand, carefully managing that basis risk, and of course, ensuring solvency.
The three pillars, really.
Yeah. And that innovative hybrid approach seems to offer maybe the best of both worlds, enabling much more precise, more efficient risk transfer strategies.
It really does. And if we try and connect this to the bigger picture for you, the listener,
yeah.
This kind of framework genuinely empowers you, as a risk manager, to design more tailored, more efficient products, to move beyond the sort of one-size-fits-all approach. And it raises, I think, an important question for you to consider going forward. Beyond the tangible benefits, the cost savings, the faster payouts, which are great, how can we start to quantify and then leverage the intangible benefits of index insurance? Things like enhanced client loyalty, because payouts are faster and simpler, or maybe the ability to finally cover risks that are currently seen as uninsurable. How can we use those aspects to further drive adoption and really expand the market?
A lot to think about there, isn't it? How to value those less obvious benefits. Thank you for diving deep with us today.